Hi, everyone. My name is T. Lee. I'm an Associate Fund Manager in the investment team. Thank you for attending this webinar. I'm going to give you an update of our Q1 performance. I'll start with the macro backdrop. The major news in this quarter was the collapse of Silicon Valley Bank and Credit Suisse. But the implication was not limited to the financial services sector alone. As highlighted in the chart on the left, SVB is very much exposed to the healthcare and technology sectors. Nearly half the US venture-backed technology and life sciences companies bank with SVB. And the chart on the right shows that the collapse led to negative sentiment around the healthcare and financial sectors. In terms of the implication on our portfolio, the underperformance of the financial sectors was a tailwind for us, as we did not have any exposure to the sector. Since most of our holdings have very strong balance sheets and strong cash flow generations, we haven't seen meaningful impact in our portfolio from the fundamentals point of view. However, the negative sentiment around the biotech and renewable space did put downward pressure on some of our holdings in the portfolio. Interest rate expectations continue to be a dominant macro factor, dictating the direction of the stock market in this quarter. When we look at the US market, the Federal Reserve's tightening policies appear to be working so far. The inflation rate has come down slightly better than expected, while the overall economy remained relatively resilient, as indicated by its strong labor market. However, we are not out of the woods yet, with the inflation rate still way above the 2% target. Market now expect the interest rate will peak around second quarter of this year and then taper down after that. The biggest risk is if the high inflation rate persists, interest rate may not come down as fast as the market expected, and we may see a hard landing for the global economy. Our strategy saw a massive headwind due to the equity market style rotation from growth to value last year, but we saw a reversal in this quarter. Since the US inflation has trended better than expected, the interest rate expectations have come down. We saw more risk-on activities. The shift from value to growth provided a tailwind for the strategy in this quarter. And here's our performance in the longer-term context. The style rotation was a major headwind for us last year. But on a positive note, we did have a very strong outperformance over the last 9 months relative to our benchmarks. Looking at our Q1 performance, our strategy outperformed our benchmark MSCI World by 1.3%, as we saw the tailwind from the style rotation from value to growth. Our lack of exposure to the financials and energy sectors also helped, as both sectors underperformed in this quarter. From the theme perspective, due to the risk-on sentiment, we saw stronger performance from our more cyclical themes. Resource efficiency theme was our best performing theme, followed by clean energy and sustainable transport. On the negative side, health was our worst performing theme. It was partly due to the concerns over biotech funding that I mentioned earlier. Environmental services and safety themes were also weak. Starting from the positive side, our resource efficiency theme was our best performing theme, and it was driven by strong performance from ANSYS. ANSYS is a global leader in multiphysics engineering simulation software for product design and optimization. Simulation software can be used to improve product efficiency. For example, ANSYS claims a 12% improvement in EV power density through the use of this simulation software. Traditionally, ideation and design are where most of the demands come from, but now ANSYS is expanding into the entire product life cycle, including manufacturing and operations, benefiting from the growing demand for 3D printing and digital twins. Digital twin refer to a virtual representation of any real-world object updated with real-time data which can be used for predictive maintenance. More importantly, a lot of this new application help to reduce environmental impact in the manufacturing and operations phases. Simulation software is a very attractive high growth market. There are a number of growth drivers, including electrification, 5G, mobility autonomy, and industrial industries of things. Another main reason is that it makes economic sense. Software simulations helps companies drive revenue growth through faster time to market and reduce costs by improving efficiency. The overall simulation market is expected to grow at 8 to 10% annually to 2025, with new use cases growing twice as fast as the traditional use cases. In the recent quarter, the company published a very strong set of results, beating every metric of its own guidance. It also provides full-year outlook, which is well ahead of the market expectations, driving very strong performance of its share price in this quarter. Clean energy was our second best performing theme, and it was led by the US module manufacturer First Solar. First Solar is a leading supplier of thin film modules in the US. First Solar is now very uniquely positioned in the US market from the regulatory point of view. Due to the potential human rights issues associated with polysilicon production, the US has banned the import of Chinese polysilicon modules. In turn, First Solar saw a growing demand for their products as they do not use polysilicon as raw material. As you can see the chart on the right, even though the company has a very rapid capacity expansion plan, it's already sold out for almost the next 4 years. We also find it interesting to learn that a number of its customers are now willing to sign multi-year contracts with First Solar after having learned a lesson of the supply chain disruptions during the pandemic. We believe First Solar has a very bright future. 2022 was a very challenging year for the solar market due to the supply chain disruption and inflationary pressure. A strong rebound is expected for 2023, and in a longer term, we do expect the US Inflation Reduction Act will provide a very meaningful growth driver for the solar market in the US. According to Solar Energy Industry Association, the IRA will drive an additional 222 gigawatts of solar over the next 10 years, or 69% more solar deployment. It means the solar industry will be 5 times bigger in 2033. On the negative side, our health theme was a worst performing theme. It was led by Globus Medical. Globus Medical is a US spinal medtech company. It has a best-in-class portfolio of solutions to promote healing in patients with musculoskeletal disorders. The reason we invested in this company because we really like its focus on innovation. The picture on the left shows the world's first robotic navigation platform launched by the company to support surgeons in spinal operations. And the chart on the right shows that the company has consistently invested more than its key competitors in terms of R&D as a percentage of sales. And through its investment in R&D, it has consistently delivered revenue and earnings growth well above the broader spike market. In February this year, the company announced a merger with its key competitor, NuVasive. The merger will make it the second largest player in the spine market, just after Medtronic. However, it was not well received by the markets because many previous deals in the sector face significant challenges. Many have seen very high transaction dyssynergies. While the management tried to convince the market with some mitigating factors, for example, there's very minimal business overlaps between two companies. However, we remain skeptical about the deal. We see there's a high risk of commercial disruptions in the near to medium term due to two very distinct organizational cultures. there's also a potential risk of product rationalization. We also don't like the fact that management previously said that they wouldn't acquire invasive, but at the end they did, which weakened our conviction in management quality. At the end, we decided to sell our position in the company shortly after the announcement of the merger. Environmental services was also a weaker theme in this quarter, and it was led by DSM. DSM offers a range of innovative food and feed supplements for human and animal nutrition to promote healthy diet and to reduce environmental impact of food production at the same time. The company has gone through various reorganization and restructuring over the years. In May last year, the company announced a merger with Firmenich, a leader in fragrance and flavor. The deal was just closed last week, and the deal has transformed the business from the current 3 business segments, including animal nutrition, human nutrition, food and beverage, into 4 segments with the addition of perfumery and beauty. On the surface, perfumery and beauty does not look like a very impactful business, but Firmenich promotes the use of bio-based ingredients to replace fossil fuel-based ingredients in fragrance to promote circular economy. And 95% of these products are already biodegradable. Its share price has been under pressure due to a number of reasons. Firstly, the lengthy regulatory process of the merger created volatility of the share price. Secondly, the overall ingredient market sector has been weak, as it was seen as a bond proxy due to the defensiveness of the sector. With the rising interest rates, investors were switching out of the sector. And lastly, DSM suffered from a huge downward price pressure for certain vitamins, particularly for vitamin A and vitamin E. Now I'm going to talk about a number of key developments that we have seen in our space and how they may affect our portfolio. With digital transformation, chips have become strategic assets for some of the key industries. Also, semiconductors are key to sustainability transition. The 43 billion euros European Chips Act is the EU's effort to cut its reliance on the US and Asia following the supply chain disruption during the pandemic. It aims to double the block's share of global total chips output from the current 10% to 20% over the next decade. Together with the US Chips Act, they will drive additional investment opportunities and demand for our invested companies. Infineon is a clear beneficiary of the European Chips Act. It's a German manufacturer of power semiconductors. It's planning to open 2 new plants in Germany for 5 billion euros, hoping to get 1 billion euros subsidies through the European Chips Act. Daifuku and Keyence are 2 other examples. Daifuku provides clean room automation solutions for semiconductor production, and Keyence provides vision systems and sensors to help improve efficiency and quality in semiconductor manufacturing. We expect both companies to see incremental demand for their products as their semi-customers look to diversify their supply chain geographically to reduce geopolitical risk. Semiconductor is a very water-intensive industry, so let's talk about water for a moment. Global water challenges tend to receive less attention compared to climate change, even though water provides a significant foundation for a number of sustainable development goals. The UN held its first water conference in almost 5 decades. More than 9,000 people attended the event, 3 times more than the UN was expecting, indicating the growing attention on water. Even though there's no binding commitments coming out of the conference, there are around 700 voluntary commitments from various governments, NGOs, and private companies. We have a very serious water problem globally. 2 billion people, or about a quarter of the total populations, do not have access to safe drinking water. 3.6 billion people do not have access to safely managed sanitation. At the same time, the global water demand is expected to grow by 55% by 2050 due to the increases in manufacturing and thermal electricity generation. In the UK, we have a very serious sewage overflow problem due to the underinvestment in the water infrastructure, which I wrote about in our monthly blog. We need innovation and technology to tackle the water problem. We have a number of holdings in the portfolio which are dedicated to developing new technologies to solve this global challenge. Trimble is a very good example in our portfolio to address the water consumption in agriculture, as 72% of our fresh water is used in agriculture. They combine hardware and software to provide precision farming solutions to help farmers to improve water efficiency. Ecolab is another example. It's a sustainability leader providing water, hygiene, and infection prevention solutions. It helps its customers to identify water-related risks and to help their customers to achieve their water reduction targets by providing expertise in water management. And lastly, Xylem is a global water technology company providing innovative solutions from water transportation to wastewater treatment. For example, it provides smart water technologies which are installed in Thames Water's network. And the result was 13% reduction in water consumption. Comparing the responses from government to the last financial crisis in 2008, the responses to the pandemic have clearly prioritized sustainability agendas. We talked about the US Inflation Reduction Act in the last webinars. It's a very significant piece of legislation which will invest almost $400 billion to accelerate investments in renewable and transition to electric vehicles. It does not only provide funding, but it also provides a very stable regulatory environment for investors to invest in clean tech space. In response to the US IRA, EU also published its Green Deal industrial plan to ramp up its net zero transformation. It involves fast-tracking permits for clean technologies and fastest access to subsidies. Overall, while the market uncertainties remain high, the policies to support sustainability development have never been stronger, which provide a very supportive backdrop for our strategy. With that, I'm going to hand over to Seb to talk about investing in heat. Thank you.
Very good. Good morning, everybody. My name is Seb Beloe, and as T says, I'm going to talk about heat to you now. I'm just going to share my screen. So hopefully you can see that. So let me start off by just giving you a little cartoon. My colleagues, much to my colleagues' dismay, I'm still quite active on Twitter, and actually I find it quite useful. I follow a couple of academics on Twitter who publish quite a lot of research on heat, why it's important, how we can decarbonize it, and I thought this was a fun cartoon for illustrating its importance. In essence, there's a lot of talk now about new technologies that are available to people, solar panels, batteries, and so on. And there's even a thing called the climate dad, which I'm proud to say I'm a fully paid up member of. Should be climate parent, really. But this is a group of people who stand around at parties and talk a lot about their new electric car or their new solar panels. But in many ways, the elephant in the room is heat and how we decarbonize heating. Heat, whether it's for residential purposes, heating our homes and our buildings, or in commercial and industrial applications, actually represents about 40% of greenhouse gas emissions. So it's a really important area that we need to decarbonize as quickly as possible. So I'm going to talk to you this morning, first of all, about buildings and how we decarbonize heating in buildings. and then a little bit at the end about other industrial applications as well. So heating in buildings, as I'm sure you all know, is traditionally been done using fossil fuels, usually natural gas, certainly in the UK and in many other countries. And in order to decarbonize heating, we need to move away from technologies that rely on the burning of fossil fuels. Heat pumps rely on electricity to power them, and we can decarbonize electricity through renewable technologies, wind and solar, and so we can decarbonize heating that way. I first learned about heat pumps at university, and there is something slightly magical about the technology. And the way it works is illustrated in the diagram here on the slide. Essentially, you take a refrigerant which absorbs heat from the ambient environment, either from air or from the ground, or sometimes from a water body. This is the blue part of the diagram. And even at temperatures of below freezing, -5, 6 degrees, there's still heat in the air, and the refrigerant can absorb that heat. It's then compressed as it comes into the building. It's then run through a heat exchanger where the higher levels of heat that you get when you compress the refrigerant, that heat is transferred to either air or water through a heat transfer, and then that's used to heat the house or the building, and then the refrigerant passes back outside through an expansion valve, and the system starts again. And the only energy you need is the electricity that's used to power the pump and the compressor. And because the heat is collected from the ambient environment, nothing is actually burned. The only energy that you need, is the electricity that's used to run the pump and the compressor. And this means that heat pumps can be very efficient. I have a heat pump actually just outside my office here, humming away, which over the 6 years that we've owned it, on average produces about 3 units of heat energy for every 1 unit of electricity that we put into the system. So you're getting efficiencies of 300%, which is much better than you get with a gas boiler, which is typically around 90%. So we think this is a critical technology for decarbonizing heating in buildings. There are others. There's green hydrogen, which you can run through a fuel cell, and that can help reduce greenhouse gas emissions. All the studies suggest it's much less efficient, much more expensive than a heat pump. And so we think that heat pumps are probably going to turn out to be the best technology. So while the technology is more efficient than a gas boiler, of course, that's not the only question. The other very important question is around the economics of the system. Typically, the upfront cost of a heat pump is higher than for a gas boiler. That's not always the case, but it generally is the case still. But then you get better reduced OPEX through the higher efficiencies. And so the total cost of ownership in many parts of the world is actually below that of a gas boiler. This is data from Daikin. It's a couple of years old now. And the increase in electricity and gas prices that we've seen over the last 12 to 18 months has actually increased the differential between heat pumps and gas boilers. So in Japan, South Korea, Germany, but also in the US, Italy, France, the total cost of ownership unsubsidized of the heat pump is now even better than it is shown here. The UK is a bit of an outlier, as you can see here on the slide, where it is still, even with the higher electricity and gas prices, it's still more expensive to run a heat pump than a gas boiler in most applications in the UK. This is primarily a policy choice where we've chosen to apply high levels of taxes to electricity than we have to gas, which disincentivizes the use of heat pumps in the UK. It is something that's being reviewed by the government, but to date, at least, this is still the situation. But with the economics across the rest of the European market and some generous subsidies as well in many jurisdictions, we are seeing an acceleration in the residential heat pump market. So you can see here data again from Daikin, the Japanese company that makes heat pumps. You can see the acceleration from around 500,000 units, just under 500,000 units in 2020 to over 7 million units per year in 2030. That's what's anticipated. And recent data that was published by Carbon Brief, you can see here the really quite phenomenal levels of growth that we're getting in some markets. So Belgium, a relatively small market, has grown, has doubled in 1 year. This is from the end of 21 to the end of 22. Still a small market, though, around 50,000 heat pumps a year. Poland, a much larger market, you can see a bit further down in the graph, grew 120% last year, more than doubling from about 100,000 heat pumps to over 200,000. And Italy, the largest market of them all, grew only, quote unquote, 37%, and has gone from 360,000 units to nearly 500,000 units in a single year. So really tremendous growth. And again, you can see the UK clearly underperforming as a large economy, still respectable 40% year-on-year growth, but it's still a very small market. It's only around 60,000 heat pumps a year, smaller in fact than the Czech Republic. And if you look at it on a per capita basis, last year, Italy was installing about 1 heat pump for every 100 people. France was doing 1 heat pump for every 200 people, and the UK was only doing 1 heat pump for about 1,000 people. So we've got a lot of work to do to catch up with the rest of Europe. So that's the backdrop in terms of the market, the technology. In terms of our investments and where we're positioned, this is still a relatively fragmented market. My colleague Victoria McLean went to Europe's largest heat pump fair in Frankfurt a couple of weeks ago. 200,000 people attended that fair, 2,500 exhibitors, including many of the companies on this slide. There are actually over 40 heat pump brands in Europe. And while it is fragmented at the moment, it is consolidating very quickly. Just this morning, we heard confirmation of an acquisition by Carrier of a German heat pump manufacturer. So we expect it to consolidate. And we do believe that actually it's the larger manufacturers that will, there are a number of reasons why larger manufacturers are likely to dominate the market. For example, brand is still quite important in terms of conveying quality. Larger companies can provide training centers for installers who are still learning about the technology. Software is becoming a bigger part of the proposition to customers, and that's something that larger companies can invest more into the development of software. And there are economies of scale in manufacturing as well. So we do think that it will consolidate and the larger players will win. Daikin is a key holding for us here, the largest heat pump manufacturer in Europe, and the one with the largest anticipated growth in manufacturing. There are likely to be a million additional heat pumps manufactured in Europe in the coming years, and over half of that commitment is from Daikin. And then the other two, Train, which is a more commercial, more focused on the commercial market, which I'll come back to in a second, and then Ariston, which is in our European fund, and is a sort of standard there for the European companies, is also an acquired a German company called Centrotech recently. So those are the three that we think are best placed to succeed in this market. So before I finish, I did also want to talk about industrial heat. This is a market which is a bit further back than the domestic heat pump market, which is clearly inflecting. We've yet to see this inflect in industrial heat. Heat pumps are important here too. In fact, about 40% of industrial heat demand is at relatively low temperatures of less than 200 degrees, which is a part of the market that heat pumps can serve very well. So I mentioned Train, which has technology here. And this is technology that's used in food and beverage processing, pharmaceuticals, pulp and paper, textiles, those kinds of things. You do need higher heats, higher levels of heat in other industrial applications. So in ceramics, petrochemicals, you need higher heat, and you can get that through some of these other technologies, resistive heating, electromagnetic heating, and then the really high temperatures you need things like electric arc technology and plasma torches. if this whole market was to move to electricity from fossil fuels, it would be about $1 trillion market. At the moment, though, it's much smaller. The heat pump market is around a $10 billion market per year. As I say, that hasn't really begun to inflect yet, but we expect that to happen as pressure builds on companies to decarbonize their manufacturing processes. And the industrial heating market overall is around $36 billion currently. But those are both numbers that we expect to grow quite rapidly in the coming years. So the only company that we currently have which has exposure, or meaningful exposure to industrial heat is Spirax-Sarco Engineering. They're a UK business. Some of you may well have heard of them. Their main business is actually in steam and helping their industrial clients use and manage steam very efficiently. So if you see in this little chart here, that row below the headings, the focus of Spirax-Sarco is on the steam loop technologies. So once you've generated your steam using fossil fuels, then how you use it, that's where they're focused. But they have got this other business called their electric thermal solutions. And basically what that does is focusing on helping their clients use renewable electricity to generate the steam. And that's where the ETS business focuses. And then they still have their steam business that's focused on helping them use that steam more efficiently. At the moment, their ETS business is about a £200 million a year business, so still pretty small. Spirax overall is about 1.5 billion pound business, so it's a small part of their business, but one that we think is very well placed to capture growing demand from industrial clients who are looking to decarbonize their heating systems. So I hope that's helpful as a little introduction to a new theme that we're focused on, that of heat. And with that, I will hand back to Sarah for questions. Thank you very much.
Thank you, Seb. That was really interesting, especially as heat pumps are something we can put into our own homes. We do again have time for questions now. Just to remind you, there is a Q&A function at the bottom of your screen. If you'd like to submit any questions in there, that will be great. And then we can start to answer them as a team. We have had a few come in already. So we'll start with the first one. T, I think this is one for you. It's talking about the trend in earnings revisions for the portfolio. So are we seeing a trend in the earnings revision for the portfolio, T?
Yeah, so I think the overall kind of market backdrop is the economic growth is still very weak, and we see overall consumer sentiment is also very weak. But when we look at our portfolio, I think there's some divergence in terms of the earnings revision. There are some areas we definitely see some weaknesses. For example, in biotech and life sciences, Sartorius, which is one of our holdings in the European fund, they offer solutions for life sciences and biopharma. They have a disappointing results. And we know that that's going to have we know that there's a slowdown in demand in the space because of the stocking, because of the reduction in the vaccine demand. So that is already reflected in the earnings revision in the life sciences tools companies. That another area of weakness is the kind of more consumer-facing areas, like for example, HelloFresh, because of the very weak sentiment of consumer sentiment. So that is already reflected in the earnings expectations. But there are some areas that we see more resilience. For example, in the industrial space, we have like Infineon, which provide very positive upgrade their full year guidance because they see growing demand for their power semiconductor as auto OEMs are transitioning to electric vehicles. Similarly, T Connectivity have also much more resilient kind of business model, have very diversified sector exposure, which really help to help them to go through this kind of most volatile market condition. Another area is also quite resilient is solar space. We talk about First Solar they already sold out in the almost the next 4 years. So we haven't seen any kind of implication on the earnings revisions from the analyst. Having said that, Enphase did provide a disappointing Q2 guidance yesterday night, so we will need to look into more detail on that. So overall, I think that the beauty of our portfolio is that we have really very diversified theme and sector exposure, which will help to reduce the overall volatility of the portfolio.
Okay, great. Thanks, T. The next one, Seb, is for you. And it's talking about that slide you had of all the players in the heat pump sector. So given a large number of players in heat pumps, what sets the 3 portfolio companies apart in terms of competitive positioning and barriers to entry? And can we comment on any margin developments there?
Yeah, sure. So thank you for the question. So the 3 businesses that we own are quite different. Daikin is a Japanese company there. None of these businesses are pure play heat pump manufacturers, I should say as well. Their larger business tends to be in, at least in Train and Daikin, in heating, ventilation, and air conditioning, so HVAC. And that was the original reason we own those businesses, because we see them as offering a more efficient solution for air conditioning in particular. But both do have significant heat pump franchises as well. Daikin in particular has really established itself as one of, if not the leader in the market in Europe. And as I said, and also in the US as well, and other geographies. So they are in many ways considered to be the global leader in heat pumps, then in Mitsubishi, probably Mitsubishi Electric. And we, as I said, we think it will consolidate this market, that the larger businesses are well placed to outcompete the smaller ones. We are seeing very rapid consolidation of the market. So Daikin has a head start in terms of announcements around additional manufacturing capacity. As I said, of the 1 million additional heat pumps that are expected to be manufactured in Europe in the next few years, over half of that increase is going to be Daikin. So we expect them to maintain their leadership position. Train is a slightly different story. They are more focused on the commercial market rather than residential. And the commercial market is further behind, as I said, in terms of heat pumps. But we very much like that business. We think it has a really strong proposition, particularly around software and controls. And we think that they will outcompete in that market as well, although, as I say, it's still very much in its early days. Ariston is a slightly different candidate. They are a smaller European business held in our European fund, but they have been an acquirer too. They acquired a business called Centrotech, a German heat pump manufacturer. So we think they're all well positioned from a competitive point of view in a market that is consolidating. In terms of margins, it's still a little bit difficult to see the margins sometimes on the heat pumps because they are consolidated. They don't report these as separate businesses. We expect it to follow a sort of HVAC kind of model. And as the business consolidates, we expect those manufacturers to be able to get good margins from their businesses. There may well be a bigger service component as well, which tends to be higher margin. And that's certainly something that we're seeing Daikin and others try and establish a service business alongside their manufacturing activity.
Okay, great. Thank you, Seb. The next one moves back over to T, and it's really talking about interest rates and how we're viewing the markets. So what is your view of interest rates and the chances of recession and revised valuations over the next 12 months?
Yes, so first of all, we are not macro fund. We don't form a macro view what the interest rate will look like in the next 12 months or so. But personally, the way I see it is like we have gone through this decade of near zero interest rate environment. I guess in analyst class, we are so used to this kind of environment, analysts are now expecting that the interest rate will come down very quickly after peaking around the Q2 that I mentioned. But the thing is, like, inflation rate is still very sticky. As far as we can see, even though it has trended back slightly better than expected, but it's still remaining very sticky. We have seen wages have gone up. So whether that will have a ripple effect in the next phase to drive the inflation further up, that's another question. So I think at the moment, market pretty much assume that the interest rate will come down quite soon. That is the major risk. If the interest rate will not come down as fast as market expected, then the valuation will get hit, particularly for more kind of growthy stocks. As we have seen, like last year, with this rather sharp start rotation from growth to value, just because the market expecting high interest rates, high inflation rate, and have to incorporate those expectations into the valuation. So I think there is reasonable risk that the interest rate may stay higher than what the market expects, and then if that's the case, then the valuation has to come down to reflect that.
Okay, thanks, T. There's a second part of that question, which really is for you, Seb, and it's talking about heat pumps again. And will heat pumps produce residential temperatures similar to that of gas?
Yeah, thank you. Again, good question. That has certainly historically not been the case. So heat pumps tend to produce lower temperature. And historically, you've had to, if you're looking at a retrofit, you have to change your radiators to larger, so you have a larger surface area, or you have underfloor heating, which gives you a larger surface area that allows you to achieve the same temperatures with a higher temperature that a gas boiler would get with a traditional radiator. So that obviously adds a lot of cost if you're trying to retrofit a heat pump. Actually, there are now high temperature heat pumps where you can get temperatures that are close to what you're getting from a gas boiler. So Daikin have a new residential heat pump that gets a much higher temperature. And so the need to retrofit bigger radiators, increasingly that isn't the case anymore. And that you can just swap in a heat pump more easily than you have traditionally been able to. So the technology is moving ahead quite quickly. The other point perhaps just to make here is I originally said that the initial capital outlay on a heat pump has historically been much higher than a gas boiler. And that is the case, but it isn't the case actually in some countries. In Sweden and Denmark, for example, where they have very established heat pump industries, the economies of scale that you get when it's become the dominant technology mean that actually the upfront cost of a heat pump is no more than a gas boiler. We've got a long way to go in this country before we get to that point, but the long-term sort of outlook is pretty good actually, that you can get the higher temperatures and the upfront costs can come right down as well. So that'll be really helpful in terms of the economics of the heat pump versus the gas boiler when that happens.
Hopefully the policy will change in the UK soon. Thank you for that. If there's any more questions, please submit them in the Q&A. And just to say, we are pretty passionate about this heating sector and heat pump space. We have also written 2 blogs about it in the last few months, and you can also find those on our website as well. We will wrap it up now. Again, if you have any more questions, please submit them to me directly in email. And for our next webinar, that is in July, we'll be doing another update on our impact strategy, and it will also include Seb again talking about our impact report for 2022. That is coming out, I believe, in June. So hopefully then we can share your progress from the last year, and we will talk about our latest data points in that impact report. So please join us then. But thank you again for tuning in this morning, and we look forward to seeing you in a couple months. Thanks, everyone.